This is Kimberly Anderson. I am delighted that you have decided to join us for preparing for the 2022 SEC reporting season. Myself, Anthony, and Cam we're very much looking forward to doing this again. Anthony at one point had commented that this was one of his favorite things to do during the year, was to do this presentation with me and Cam. And we both first said he needed to find better things to do with his time if that was his highlight. However, I must admit, I agree. I very much enjoyed doing this with my co-presenters. So let me first introduce who will be speaking with you today, and then we can get going. So I'm Kimberley Anderson. I'm co-chair of the Capital Markets and Corporate Governance Practice Group. So I'm a partner in the Seattle office. Next is Anthony Epps. He's a partner in the Denver office. He also works both in terms of corporate governance, capital raise, M&A. We all do quite a bit of work with public companies and all advise on SEC reporting. Cam Hoang is in our, there we go. And Cam is in our Minneapolis office. He's one of our partners that also specializes in corporate governance, as well as capital raise and M&A transactions. Cam also brings unique experience because she was, senior general counsel and assistant corporate secretary at General Mills. So she has a great deal of very valuable in-house experience, and she brings that perspective, which is why we kind of sometimes voice some of the disclosure discussions onto her because she's, had to think through these things internally. So there's some just various housekeeping methods. Just so you know, I don't know that we're gonna have time for a Q&A, but if you have questions, feel free to put them in the chat box and we can get back to you after the end of the session. All right, do not panic. We are not going through the entire agenda today, I promise. We don't have time. But we wanted to make sure these effectively summarize the various different kinds of materials that are contained that we have provided for you. What we're going to be doing today is focusing on three things. I'm going to be talking to you about amendments to MDNA and financial reporting. Cam is going to be discussing the ESG and disclosure trends. We'll briefly touch on a few other points, and then Anthony's going to be spending quite a bit of time in the proxy. We'll move from the 10K to the proxy, and he's going to discuss board disclosure, diversity disclosure. So, and then we'll, as we noted, we'll touch on a few other things, but those are the three primary topics that we're going to be discussing today, to spend a little more time in depth on those areas. So to help, prepare you for, preparing your 10K for next year, as well as the proxy. So we'll jump in, and I'm first. So I know what you're thinking. It's like, these were adopted a while ago. So it's like, and you kind of put them in the back of your mind thinking, yeah, I'm going to have to get to them at some point. So, and partly because you look at them and it's like, well, this was done here and this got moved here. So we're going to kind of walk through where things ended up, just so you know, sort of what things have been removed, what are the kinds of things that the SEC is looking for under these new MDNA disclosure rules. It also hits financial reporting. So let's jump in. So keep in mind, and you're going to notice a difference here. These were enacted under the prior administration, under when Clayton was the commissioner, and so these rules were adopted in November of 2020. The purpose of these things were really to reduce the burden for registrants, to enhance and simplify MDNA disclosure, to make it easier and more readable and less duplicative. The view here was to try to make this in some ways more reader friendly and eliminate some of the duplication. So it goes to more of a principles based disclosure, encouraging more discussion of underlying reasoning, less strict line item disclosure. So that's why you'll notice that a number of things are coming out. Under the new administration, I fully expect that we're going to be seeing more rules regarding either climate change or otherwise that are more prescriptive. So, but in this one, this is very much sort of a more holistic view of MDNA. So for December year-end companies, compliance will begin with your next 10K. So you were always allowed to do early compliance. It is certainly possible that some of you have already gone through these and made all the changes, but in case you haven't, we'll jump in and go through them again. So one of the things this does do is it clarifies the objective of MDNA. They added a section at 303A. They added this to explain what the purpose of MDNA is. It really codified things. Now, realistically speaking, when you read it, most of it's going to sound very familiar because much of it came from either instructions or from prior SEC guidance. But effectively, what the SEC really was looking at is they really wanted to emphasize cash flow and forward-looking information. They want people very much affirmatively to be looking forward, giving investors a sense of what our needs going to be, what are we seeing coming down the line, what are the trends. So they're trying to have investors get a better sense of viewing the registrant through, like they always say, through the eyes of management. That's really the goal here, is to really give someone a really solid sense of not just, retrospectively where the company has been and the reasons for X, Y, and Z, but where it is going and what those reasons are going to be in the future and what trends they're seeing. So as we've noted, it has things like the information relevant to an assessment of financial condition. It has, you're going to focus on material events and uncertainties. And a phrase that's being used more, and you're going to see this a lot, is the concept of reasonably likely. So for material events, reasonably likely to cause reported financial information. And so you have to understand the concept of reasonably likely. Some commentators did note that this is a hard threshold to understand. What does reasonably likely mean? And the SEC acknowledged that. They understood that this is not cut and dried. But then when you understand the concept of materiality, that's not really cut and dried either. So when it comes to some of these things, what you're really looking for is it's going to be based on management's assessment. So when we're talking about these descriptions, it's going to be based on management's assessment, and you have to fundamentally consider what a reasonable investor would consider material when making a decision to invest in stock. That's what it comes down to. Fundamentally, it all goes back to that standard of materiality. And so, but the concept of reasonably likely, there's no bright line rule, there's no, specific percentage you can have in mind. But what it really comes down to is management's assessment, because fundamentally, that's what we're really looking for here anyway. All right. So what's gone? Because you're thinking, simplification, stuff may be gone. Stuff is gone. Most of it's just moved and revisited, but nonetheless, some stuff is gone. It does eliminate the 5 years of selected financial data that was required in 301. Because keep in mind, one of the purposes here is the SEC is like, look, this stuff is in the financial statements. So there's no point in simply putting in a lot of duplicative information. They understand these reports are very long anyway. And so they're trying to, one of the goals really is to streamline some of the disclosure. So some of the stuff goes away. One of them is then the 2 years of supplementary financial information. So great, that's gone. However, it's not completely gone. It's mostly now been revised. So essentially, this has now been replaced with, again, we go to that that concept of principles-based disclosure of retrospective changes. So in many instances, you're going to blow past this item requirement and not worry about it. However, where you have one or more retrospective changes to statements of comprehensive income for any of the quarters within the 2 most recent years, they have to be materially, individually, or in the aggregate. If there's multiple changes, small changes running through, those changes in the aggregate may be material. So, and if that's the case, then you would have to put in an explanation of the reasons. Explain what's happened, what's the change, what are the reasons for the change, and then you also have to disclose summarized financial information for each of the relevant quarters as well as the fourth quarter. So that's, so for most companies, this is something that will be effectively ignored and can be removed. But if there have been retrospective changes, this is the item that's going to impact your disclosure. So, all right. So other things did come out. Some of the other line items did come out. So inflation and price changes. So those are replaced, so those have been removed, but replaced with a new instruction to discuss that under general MDNA, because if they're part of a known trend or uncertainty. So in other words, you no longer have to have an inflation section if it's something that doesn't impact you. If it does impact you, it should be discussed in any event and would simply be discussed as part of the M&A. Off balance sheet items. So if these are material, again, that would go as part of your discussion under MDNA, but you don't need that separate specific disclosure of saying, whether they're already, et cetera. It's only going to be there if it's material. The contractual obligations table, gone. That has now been replaced. Again, we go back to the concept of the principles-based discussion of material cash requirements from known and contractual obligations. So that's going to be as part of the liquidity and capital resources section. So some of these other requirements that were there, they can be removed to allow you to essentially have this part of a generalized discussion. So if they are material, it's going to be showing up, or it should be showing up as part of your MDNA. Okay, so I want to go through just a few more points before we move on to Cam. I want to go through just a few more points in terms of some of these changes. So the concept, as we talked about before, the concept of known events that are reasonably likely to cause a material change. So in other words, you're not just discussing a cause, but if there's, you remember that concept of sort of known trends or uncertainties, something's reasonably likely to cause a material change in the relationship between cost and revenue, that should be discussed. For example, if labor costs are increasing and we're seeing a number of people having to pay more for employees, et cetera. So that increase in the labor cost or that trend, if there are pricing changes, if, for example, there are sometimes supply chain issues, if that impacts pricing or any inventory adjustments, et cetera. So if it's reasonably likely, you need to really think about, not just what has happened, but try to project what are we seeing that may be causing a material change. We need, so you want to make sure that you're clarifying and explaining that. Okay, and this one, I don't know anybody who actually, the old rule under 303B, I guess it was A before, but nonetheless, it only asked for material increases in sales or revenue. Well, they corrected that, so it's now material changes. I must admit, I don't know anybody who only ever discussed changes and didn't discuss decreases. I don't know, Anthony or Cam, did you guys ever see anybody who avoided disclosure based on the technical reading of just, increases and not, just any material change?
Yeah, I know it does seem like that's something people were doing before, and this rule just really documents that. I agree with you.
Yeah.
I agree as well. I don't think anyone was really reading this rule from a technical perspective, but right. Before and saying they didn't have to, they were doing it before.
Right. Because after all, this is a liability document, and that's how we treat it. All right. So, so one of the things that I think is actually worth noting is the discussion of the underlying reasons for material changes in line items. So this is something that the SEC was focusing on. So this discussion should be in quantitative and qualitative terms, where material changes within a line item offset one another. So if you have a line item that hasn't changed much from one year to the other, but there are, massive fluctuations within that line item that just manage to offset each other, that should still be disclosed. The SEC did acknowledge that sometimes, sometimes you'll see, clients say like, well, this happened because, this went up by X offset by this, and it resulted in X, Y, and Z, or this change. So, but the SEC did acknowledge that sometimes isolating and quantifying reasons for specific material changes can be difficult and can be very challenging, because many things are highly interrelated. So, you know, and the SEC acknowledged that and said, look, if this is the case, just say that. You know, try to explain the interrelated circumstances. So in other words, don't ignore it because it's tough. You can go ahead and acknowledge the fact that you have interrelated issues here. And then they did add a discussion that, you know, if a discussion of product lines is necessary to understand the business, you know, in terms of when people used to talk about segments or divisions, et cetera, if product lines are the way that you should be discussing things to essentially help investors understand the company and its business, then you should do so. Liquidity and capital resources were, you know, more detail around the cash needs. So it used to be, we always wanted to make sure that people said, like, look, they got enough cash for at least 12 months. They do want both short and long-term sources of liquidity. Short is within 12 months, long is greater than 12 months. And then you're going to be analyzing material cash requirements from known contractual and other obligations. You know, the type, you want to talk about the type of obligation, et cetera. So remember when we said we got rid of the table of contractual obligations? Much of that disclosure, to the extent that it's material and so on, is going to be showing up here. All right, so capital resources. They do want the, as we said, they want the focus on material cash requirements and the anticipated sources of needs. So they changed the name from expected material changes to reasonably likely material changes when you're talking about the mix and relative cost of those resources. So if a company says, look, we're not quite sure what to expect, it's like, you know, we're not sure what to expect, you know, it could come from X, Y, and Z. They do want some analysis here of, you know, what is reasonably likely. In other words, you probably shouldn't just punt on this one because you're not entirely sure where it's going to come out in terms of sort of expectation. You should actually, there should be some discussion about where you think that's reasonably likely to occur. All right, critical accounting estimates. They put this in, they do want this language in here. However, you can't cheat. So in other words, you can't simply pull the disclosure of critical accounting policies from the notes of the financials and drop them in. They say, no, 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 no. We want this to supplement that information. We want qualitative and quantitative information to actually understand the estimation. And, you know, how have these estimates or assumptions, how they've changed over the period, the sensitivity, et cetera. So they do actually both require the disclosure and they require some thought to that disclosure. And last but not least, it doesn't impact your 10K, but you know, you can start thinking about it for your quarterlies. You can now change how you do your interim reporting. You can do it as you typically did it, which is Q1 of this year versus Q1 of last year, or you can actually do, you know, Q1 versus Q2. If, you know, whatever is going to, you know, you can pick as to how you want to compare these, because it may be that it's more illustrative for the reader. And because ultimately the fundamental point here is to ensure that you're providing as clear disclosure as you can to the investor. And that means good news and bad news. I was laughing a long time ago, I think when I was an associate, a client said, oh, I really don't want to have to disclose this, you know, because investors aren't going to like it. He's like, yeah, that's when you really have to disclose it. If it's going to make somebody unhappy, you disclose even faster. So it's, yeah. So yeah, just assume that if it's bad news, it does need to go in there and you need to describe it clearly. All companies face challenges. So, all right. I'm going to turn it over to Cam for a discussion of ESG disclosure trends. And so, Cam, when you want me to flip forward, go ahead and just say next, and I promise to pay attention.
Okay, thank you so much, Kimberly. So, as you can tell from Kimberly's discussion under Jay Clayton's SEC, the SEC was really all about, you know, streamlining disclosure, and when it came to ESG disclosure, making it principles-based, so that companies really had the discretion and the judgment to decide what was material and what should be included in their SEC filings. Well, we've come to another chapter in the SEC's life under SEC Chair Gary Gensler. we expect that the agency will be moving very much towards a more prescriptive approach to ESG disclosure, and there will be an emphasis on consistent, comparable, and decision useful disclosures. Next slide, please. The chair has asked his staff to consider a number of areas in formulating recommendations for climate disclosure. So for example, whether the disclosure should be included in the annual report on Form 10K, how qualitative disclosures can answer key questions about how a company's leadership manages climate-related risks and opportunities, and how these factors feed into the company's strategy. And then on the quantitative side, rules may require disclosure on greenhouse gas emissions, the financial impact, and progress towards climate-related goals and greenhouse gas emissions disclosure. And in particular, what's gotten a lot of attention is these questions on disclosure of Scope 1 and Scope 2 and Scope 3 emissions. And so just so we're all on the same page, according to the EPA, we're talking about Scope 1 emissions. Those are really directly from sources that are controlled or owned by the company. And Scope 2 covers the company's purchase of electricity, steam, heating, or cooling in its operations. Scope 3 is what is causing a lot of companies a lot of stress and wondering, because really they're the results of activities that are outside of the company's control. So it could be upstream, for example, emissions from supplier distributions and transportation, and it could be downstream, which are carbon emissions that result from consumer use of their sold products. In addition to these
Kim,
yes,
it occurs to me the concept of Scope 3 emissions and trying to figure that out. It reminds me of conflict minerals, where you had to find out, where everything was coming from upstream in terms of, it required enormous amounts of due diligence by companies. Scope 3 almost reminds me of you'd have to almost do a similar exercise in order to try to figure out those things. But it seems like, I'm not surprised people are stressed. It seems like a massive undertaking.
Yeah, for sure, Kimberly. And also it begs the question of how these results would be audited. So companies are definitely, they're nervous about all of this, but I do think that the Scope 3 emissions challenge is something that will require considerable investment in time and expense to get there. And so in addition to the quantitative disclosures, I know the Commission is also questioning whether there need to be industry-specific metrics for banking, insurance, transportation, oil and gas, and also whether companies should be providing a scenario analysis as to how their businesses might adapt to a range of possible physical, legal, market, and economic changes that will occur in the future. Very much forward-facing disclosure, and much more to come on that. Next slide, please. And so if we're going to focus a little bit on qualitative disclosure and the governance and the risk management oversight of climate change, we're already seeing quite a few companies provide that type of disclosure in their proxy statements and other SEC filings. And so I've just provided here a graphic on ESG oversight from General Mills's latest proxy statement. And what you'll notice here, once you have a chance to take a closer look, is that it's really a map of how the company's leadership is going to manage climate-related risks and opportunities. And they're really addressing it both at the board level and also at the management level, and talking about how those processes are interacting and intertwined. And it may be obvious to say, this is a multidisciplinary effort. So we're talking about efforts both from the very top with the CEO, but then also having the input of finance, sourcing, law, innovation, technology. It really is a company-wide effort, and it's integrated into the business. Next slide, please. On the qualitative side of climate change disclosure, so many of those disclosures are being driven by net zero pledges by companies. So it's important to understand what these pledges entail. So in order to reach the Paris goal of limiting global warming to 1.5 degrees Celsius, companies are pledging to limit their carbon emissions so that the level of greenhouse gases in the atmosphere does not rise any further after 2050. And it actually was quite eye-opening for me to realize that nearly 33% of the largest public companies in the G20 have net zero targets already. And what does this mean? It means that they're pledging at a leadership level to reach that net zero level by 2050. They're explaining the steps that need to be taken in order to achieve this goal. They're setting interim targets and also pledging to report on their periodic progress against these targets. And so exactly how does a company reach net zero? I do think that the answer is still evolving there, but the discussions that companies are having include reducing carbon emissions from their business activities, so limiting the use of fossil fuels and just becoming more energy efficient in their facilities. It also means investing in carbon offsets that reduce overall carbon emissions globally. And so, in place of actually directly reducing their carbon emissions, companies will invest in renewable energy products outside of their own operations. And this understandably is quite controversial, and there's discussion around this. And finally, companies are talking about removing carbon emissions from the environment using reforestation and carbon capture technology. Now, this graphic that we've included here from post COP26 snapshot really is covering the types of pledges that companies are making. And what's kind of plain here, if you look at the graphic, is that companies are making pledges with regard to their scope 1 and 2 emissions. It's the scope 3 emissions that really are still an unknown. Next one.
Kim, one thing I wanted to note is, and I think we've heard this commentary by companies before, is that I think companies, even if they're making these pledges and saying how they're going to be doing these things, they need to be flexible in terms of if something's not working, or if technologies develop, or how they're going to be, trying to reach their goal changes, that they should be kind of going into this knowing that they need to be flexible in terms of how they describe things, because this is an area, as we've noted, is going to be evolving. And so just making sure that you're not so deeply wedded to your disclosure that you feel like you can't change something if it makes sense.
Yeah, definitely, Kimberly. And it's interesting to note, by and large, this disclosure is still very much in the realm of corporate social responsibility reports. They are slowly starting to make their way into SEC filings. And of course, this upcoming rulemaking that's being proposed by the SEC will kind of hasten that process. But it's still very much an evolving area. I mean, first of all, in terms of the technology involved, but then beyond that, the business practice and the legal consequences. So recent SEC comment letters on climate change provide a potential roadmap for future rulemaking. Some of the comments ask for more MDNA discussion of material impacts from climate change. And what's notable here is that the SEC just didn't issue comment letters to specific companies. They took the extra step of providing a sample comment letter to the general public. And I think that this is their message to say, hey, this applies to everyone and to all companies. And so all companies, pay attention to these comment letters. And even before the rulemaking hits, let's look and see if some of these disclosure comments apply to your business, and start thinking about incorporating them into your SEC disclosure. The letters are really grounded in themes that are found in the Commission's 2010 climate change guidance. And so at a recent SEC Speaks conference, the staff provided a practice point that companies really should be crafting their disclosures with a view to this guidance. And furthermore, that if companies aren't providing disclosure already about applicable legislative and regulatory developments on climate-related expenditures, but the company's peers are, the staff may be asking for additional analysis. And so I think that's a useful practice point to really just be cognizant about where your peers are in this space. Based on private remarks, the chair has indicated that the rulemaking will be released in 2022. And so, we're kind of in an odd gray space right now where there are comment letters on climate change, but we haven't actually seen the SEC rulemaking yet. So I kind of wanted to ask you, Kimberly and Anthony, how are you counseling your clients about what they should be doing with regard to this year's 10K?
So my view of this is that, and then I'll let Anthony weigh in, is that companies should, of course, every year revisit their disclosure to make sure that it's developing the way the company is developing. But this disclosure is in the disclosure request with respect to climate change has been around for a while. I would consider it if they believe that there is some disclosure that would be, a useful add, particularly in light of the company, the SEC's statements about principles-based disclosure, I would certainly add it, but I don't know that I would do a full revamp of climate or adopt brand new policies in response to these comments. I think a number of companies may have to focus that when they see sort of the proposed and final rules, but you should always consider all of these points because this guidance has been out with respect to the SEC for a while, and this is simply bringing it up to the forefront again.
I agree with Kimberly's approach. I think one thing that's important is that even though it was a general comment letter and it definitely applies to every company, it'll apply to every company differently. So if you are like a natural resources company or a company that is a generation company, it's different. And a lot of times you probably would have already had a lot of this disclosure anyway. It's really just beefing it up and making it more apparent. But then for other companies that really aren't in the energy space or natural resources space, it's really going to be on a case-by-case basis. Like you can add a couple of things in a general sense that this generally applies to everyone, but it gets a little bit tricky if you try to get too granular when you're not in industries that specifically touch climate, because some touch it more than others.
Yeah, I agree with all of those points. And I do think that this is an area where, even though there's this temptation, we shouldn't let the disclosure get ahead of actual practice. So next slide, please. One of the comment letter areas would be in the area of risk factors. So the SEC is asking companies to consider risk factors related to climate change. And these would include, for example, operational and compliance burdens from new policies and regulations, market trends, for example, towards renewable energy that may alter business opportunities, impaired assets, for example, facilities and plants that are no longer economic given new regulation, credit risk from borrowers adversely impacted by climate change, technological changes, and potential litigation. And so, I do think, to the point, don't let your disclosure get ahead of your practice. In addition to considering risk factors, companies need to be doing the work to integrate this type of analysis into their enterprise risk management processes. And I know that many already do. Another project that companies may consider before the actual rulemaking comes out is just taking in mind this comment from the SEC that, if companies are providing information about climate change in CSR reports, and they're doing more so than in SEC filings, really ask why that's the case. And so this might be an appropriate time for companies really just to take a critical look as to the delta between their CSR reports and the SEC filings, and figure out why is there that delta and what standards of materiality are governing each publication. Next slide, please.
So, Kim, just to touch on that point, I don't hear from you that you're suggesting that someone should take their social responsibility report and just, slip it into their 10K. They're very different documents with very different purposes. But but when it comes to, if investors are really pushing to see information about the company's social responsibility activities or environmental or otherwise, and if those are in separate reports, that perhaps some of that or some subset of that may be useful to add into your 10K. But but I assume you're not saying that just simply file it as an exhibit and incorporate it or otherwise.
I agree. It just has to be a very considered process. I mean, number one, what are the SEC requirements going to be? What are your investors expecting to see? And, also importantly, what are your peers doing? And then also realizing that, obviously the type of disclosure that goes into your SEC filings, they're just going to be, they need to be vetted. And not that CSR reports aren't vetted, but there are certain controls around SEC filings that are specific to those filings and need to be followed, whether or not it's ESG disclosure. Yeah, so moving on, just a note to say that the SEC recommendations are going to be informed by ESG disclosure frameworks that are already out there. And in fact, Chairman Gensler has asked the SEC staff to learn from the TCFD framework that I've summarized up here. And so it's definitely worth taking a look here to see the 4 pillars and themes that have been established by the TCFD framework for climate change related disclosure, which include, the governance aspects, the impact on strategy, risk management, metrics and targets, and also I think some fairly helpful recommendations as to what companies should consider disclosing in relation to those 4 pillars. Next slide, please. Something that companies will continue to grapple with is what is the intersection between ESG impact and financial impact, and how is this going to be reflected in their financial statements? And so on that issue, the Financial Accounting Standards Board has released a useful educational paper that provides investors and other interested parties with an overview of this intersection. And, I think it really is useful. So it'll walk through examples of direct impacts or potential indirect impacts, for example, asset retirement obligations that are related to the retirement of fossil fuel burning facilities, or expenses related to human capital management initiatives. And also it talks more about indirect financial impacts. So for example, reputational damage from environmental contamination. So definitely just worth a read as we ponder what this means for financial statements. So now I'd like to actually move on to human capital management, which will be another focus of SEC rulemaking. And so we all know that currently there is a requirement in the 10K for companies to provide some human capital management disclosure. And so as we survey what's been done in the 10Ks over the past year, some very common topics we're seeing, DE&I policies and practices. And for a minority of companies, there's data on demographics as reported in their EEO1 reports, talent development, attraction and retention, employee health and safety during the pandemic, compensation benefits, and training and engagement. And so at this SEC Speaks conference that I was talking about, Rima Murphy said the staff is hard at work once again, also developing recommendations, not only on climate change, but on human capital management disclosure. And once again, there is a priority on providing consistent and comparable disclosure among companies. And some of the potential areas that the SEC is considering more tailored disclosure on would be workforce turnover, skills and development training, compensation and benefits, and workforce demographics. Next slide, please. So I mentioned that companies are being asked by shareholders to provide EEO1 report information. And what this means is that there would be a breakdown of the workforce according to racial and ethnic categories, as well as binary gender categories. There's currently nothing on sexual orientation. And there's actually also a further breakdown by job category for employees. And so, yes, there's been some discussion of this and shareholder proposals on this topic, but it's still a very small minority of S&P 500 companies that provide this information in their SEC filings. Only 16 actually disclosed this type of information in 2021. But what's kind of striking is that almost half of the 100 largest companies by market cap released their EEO1 reports outside of SEC filings, for example, on their websites. And so companies like Apple, Cisco, Dell, Google are releasing this type of data. And I think companies are being very intentional about where they put this data. So next slide. Here's an example of Merck's human capital management disclosure that does include EEO1 data, and it's in their 10K from 2021. And what you can see here is that they provide 3 years of trends, and they cover the representation of women and underrepresented ethnic groups on the board and in executive and management roles. And so context is important here. This is in the 10K, it's in their business description. The 3 years of data would be consistent with 3 years of financial data. And I think it sets them up to discuss trends and material developments within their MDNA. Next slide, please. Now let's contrast this with the Visa disclosure in their last proxy statement. And so here they've opted for more general disclosure of workforce demographics. And they've broken down their workforce and leadership by gender globally and in the US, and also in the US by ethnicity. And so it's a more general disclosure. In the proxy, it would be positioned for a discussion of governance and risk management, and less so of business and material financial trends. But companies are being very purposeful about what they're disclosing and where they're disclosing it. So with that, what I'd like to do is turn it over to Anthony to provide us with an overview of risk factor developments for you to consider for your 10K.
Fantastic. Thank you, Cam. I think I'm going to keep this part really short because I'd say the most critical update for this particular cycle is for companies to look at how long their risk factor section is. If it exceeds 15 pages, then the SEC is requiring a summary in clear bullet format somewhere else in your 10K or wherever you're going to have risk factors. I think part of this is really to let companies know that the SEC is noting companies that have 20 and 30 and 40 pages of risk factors, and that's just not readable, one, and then two, it's part of the exercise of helping companies to really look at your risk factors on a very consistent basis, because that's the point. What's a risk 3 years ago may not be a risk today. So that's what the SEC is trying to get at. And then from my view, what's really great about this summary section is that a lot of companies already provide it. So you already provided in your forward-looking kind of statements that the bullet points there, and you oftentimes include bullet point summaries of your risk factors anytime you have like a prospectus or anything else. So what we did was we put together this little example where we just have the cautionary forward-looking statements language, and we said and summary of risk factors. So in order for you just to add that and summary of risk factors, you need to just make sure that this summary is good to go from a 105, a Reg SK perspective, but presumably it does, and so that there won't be that much work left for that. So I'm going to kick it over back to Kimberley to talk about HFCA Act disclosure.
So I'm going to spend about 1 minute on this, mostly because it really starts kicking in next year. But essentially, it's the Holding Foreign Companies Accountable Act. If nothing else, Congress does like their acronyms. They love naming acts. So this is going to require, there's going to be a new item 9C in the 10K that requires disclosure on essentially on foreign jurisdictions that prevent audit inspections. So the SEC will start identifying what's called a commission identified issuer. They will start doing that. There's more information in here, but they're going to start doing that after this next round of 10Ks. So people will be provisionally identified. You'll have 15 days to say, well, no, that's not us, or yes, and provide additional disclosure. If ultimately you'll have had 3 years of being identified as a commission identified issuer, there will be essentially a trading prohibition. So if this is something that may impact you, we're happy to discuss it with you in more detail. Okay, this is a plug for my separate webinar. The other thing that's going into effect for the next 10K will be the new SEC mining disclosure for everyone who's a fiscal year-end company. That is a whole hour in and of itself going through that disclosure. So you are cordially invited to attend my webinar on this one on January 6th. So that's as much as I'm going to say here. And we already announced the CLE code. So now we're going to move it back to Anthony.
Fantastic. So we can go ahead and go to the next slide. What I'm going to talk about is just Nasdaq's board diversity requirements. It's something that's fast approaching. I know I talked about this particular topic last proxy season and last presentation, and I said that Nasdaq proposed rules and the SEC was looking at them. That the SEC has actually approved that, and so that these new rules are in effect. So long story short, there's two separate requirements that get triggered at different times. So the first one is going to be the board diversity matrix, and that's going to be in new Nasdaq Rule 5606. Basically, what companies have to do is for their annual shareholder meetings in 2022, that they have to put together a matrix of who is on their board and the racial and gender makeup of their board. So what Nasdaq was requiring is that matrix either be in a company's 10K, 20F if they're a foreign issuer, 40F, or even in your proxy statement to put that matrix there. If you don't put the matrix there, the Nasdaq is requiring that you put the matrix up on your website. What's really critical about the matrix is that you're going to need to get that done fairly quickly. And so for companies who have their annual shareholder meetings at the beginning of 2022, that they're going to either have to update the proxy materials that they submitted, which we wouldn't recommend, or what they could do is just wait until August of next year and then post it on their website. So that's the first thing. The next thing is that Nasdaq's what we call their diversity objective. Nasdaq felt like it's very important for companies to at least have an explanation of why their board are or are not reflective of the general populace, mostly because you've got investors from all different areas and walks of life. And Nasdaq felt like it was a good thing to require boards to have a certain makeup as far as gender and racial diversity goes. So that's a high level what these new requirements are. If we can go to the next slide. So this matrix is a matrix that Nasdaq provides. It's just a sample on what they're looking for. Companies can deviate slightly from it, but it's a good idea just to take what Nasdaq has on their listing standards website and just download it, reformat it for your purposes, but to get the same information. So you'll know part one has gender identity, but part two has demographic background. What's super important about this matrix and all of this stuff is that companies are not required to push people to disclose if they do not feel comfortable disclosing this particular information. So if board members say, "Hey, I choose to not identify. I don't want this disclosed," Nasdaq is perfectly comfortable with you identifying that in the matrix. So they're not requiring that. So if you click over to the next slide, please, if you don't mind. What's interesting about Nasdaq's diversity matrix is that they recognize that they want this rule to apply to almost every single Nasdaq listed company outside of some exceptions. So that these new requirements won't apply to SPACs. There's lower thresholds for companies that are smaller reporting companies or have 5 or fewer board members. But for foreign issuers, the matrix requirement is still there. But the biggest difference between the domestic and the foreign issuer Nasdaq diversity matrix is that this particular matrix for foreign issuers basically has this category called underrepresented individual and home country jurisdiction. So what Nasdaq understands is that depending on where these companies are, that these companies may not be allowed to either collect the information or their definitions of racial minorities, which on the domestic side is from the EEOC. Nasdaq understands that different jurisdictions have different rules. So they say if it's an underrepresented individual in accordance with the home country's jurisdiction, then then that's fine to do that. And once again, NASDAQ is saying if it's not legal for you to collect this information in your home jurisdiction, you would just have the matrix, but you would note that it's not legal for you to collect that information. So let's go to the next slide.
Can I ask you a quick question, Anthony?
Of course.
I know we're running low on time. What if you have someone who is, let's say they are a foreign issuer, they're organized, let's say in the Caymans, but their head office is in, say, Brazil? Is it the question of underrepresentation? Is it based on the Caymans or is it based on Brazil? I assume based on the definitions, it would be based on underrepresented in the Caymans.
Correct. It would be underrepresented in the Caymans.
Okay. All right. Perfect.
So here's some interesting timing considerations for the diversity matrix. As I mentioned earlier, if you've already filed and mailed out your proxy materials for meetings that are happening in January, don't worry. All you have to do is just make sure that you comply by August 8th, and all you really have to do is just post the matrix to your website, and then go to NASDAQ's listing standards website and provide them with the link. So you're good to go on that. Newly listed companies must comply within 1 year following of a listing, and most companies we suspect are gonna include this matrix in their proxy statements or information statements. But some companies who like to include that additional information in their 10K that they could otherwise incorporate by reference into their proxy may include it there as well. So we can go to the next slide. Okay, so this is getting into NASDAQ's diversity objective. Long story short is that NASDAQ is going to require companies to have at least one director who self-identifies as female and at least one director who self-identifies as an underrepresented minority or LGBTQ. What's important about this is that that NASDAQ is saying if you don't have a board makeup like this, then it's either a comply or a disclose framework. So if your board doesn't meet this, all you have to do is look at Rule 5605F and figure out which kind of categories work and what type of company you are. And then if you don't meet the requirement, all you have to do is disclose, and the disclosure would be in your proxy, most likely. One thing that's really important though is NASDAQ is not going to evaluate whether your disclosure hits it or misses or anything like that. However, though, NASDAQ has said that, simply put, saying that we have a board whose composition doesn't meet Rule 5605F is not going to be sufficient. So we believe it's going to be more of a hybrid approach where you say, look, here's our board makeup. We're always looking for diverse candidates. As of right now, we do not meet NASDAQ standards, but we are making steps to either address this or not. So we can head over to the next slide. So these are just in chart format, just the breakdown of the timing considerations. So if you are a NASDAQ listed company or you represent NASDAQ listed companies, you've got the global market, the global select market, and the capital market. So with the global market and the global select market, you have to have at least one diverse director on your board by August 7th, 2023. And then you've got to be in full compliance by August 6th of 2025. And then if you were on the capital market, you have to have one diverse director by August 7th, 2023. And then you have to be fully in compliance by August 6th of 2026. And then as we talked about, newly listed companies have that year window. And then once that they're there, that they've got 2 years from the date that they've listed in order to get their board composition. One thing I want to ask Kimberley and Cam is that even though these are NASDAQ specific requirements, do you guys believe that, companies on NYSE and other US markets or even foreign markets who are in the US may start just providing this disclosure anyway, just to not be out of line? And what would you think that companies, when they're uplisting, would consider this to be something that they've got to consider on whether they're going to go to NASDAQ or a different exchange?
We're seeing more and more companies are including quite a bit of diversity disclosure. We see that only continuing to increase. For some companies, it could be that when they're thinking about uplisting, that they decide to look to the New York Stock Exchange versus NASDAQ. But I don't know that that would be really a deciding factor, partly because I think at some point NYSE is going to want something similar. But generally speaking, except for sort of the format and the specific issues, we're seeing increasing just diversity disclosure about directors pretty much by all of our companies. It's something that they take very seriously. Oh, Cam, you're on mute.
Sorry, it's just to say, I'm seeing it across the board, whether or not it's a NASDAQ company, and a lot of that is just driven by investor expectation, regardless of what the listing standards say.
Right. And I will note, we were talking earlier, Anthony, that like in the state of Washington, if you're a Washington entity, this year you will have the gender, the board gender requirements. It's really a matter of like, if you need to have 25% of your board members. And if you don't, it's simply a matter of disclosure about your policies, et cetera. So it doesn't force you to do it. There's no penalties or otherwise, but it's simply a matter of you either comply or you simply disclose. Much of which, like, for example, with NASDAQ, it seems to be more of you either comply with our requirements or you simply, make certain specified disclosures. It's not, you're not going to get kicked off NASDAQ or other penalties. It really seeks more of a disclosure issue. I regard it as sort of public policy based on sort of public shame. It's a very sort of Puritan standpoint, but it can be very effective. And I think it tracks with what a lot of companies are doing in any event.
Agreed. So I think that we can go to the next slide and kind of wrap this up. I think, long story short, what we're really trying to get at when it comes to diversity and board representation, this is something that's going to happen, whether it be on an exchange level, an SEC level. The SEC has already had diversity disclosure rules. It's happening at the state level, California, Washington, and others. And Glass Lewis and ISS are basically putting weight behind companies having diverse boards. So long story short, if ISS and Glass Lewis, that they're recommending no votes starting in 2022, and it's not just going to be for the Russell 3000 anymore. It's going to go down, where basically what Glass Lewis and ISS are saying is, if your board does not have requisite representation, gender and racial and ethnic and anything else, we are going to recommend people vote no for the nominating committee chair, and that's a lot of weight, but behind that, because it's basically letting everyone know that it doesn't really matter if today we're talking about NASDAQ. Last year we were talking about NASDAQ, California, Washington. Look, it's definitely happening, and our advice is look, if you've got clients or companies who are on this presentation, it's very important for your nominating committees to start thinking about this stuff early. 2022 is right around the corner, and from my experience in talking to Kimberley and Cam, it's been very, very challenging for companies to just wake up on 2022 January 1st and say, oh, our board isn't representative, what do we do? that the nominating committee needs to start having regular meetings to discuss this, engage consultants to help them find diverse candidates, and also make sure that those consultants give them feedback on what they could and should do to attract diverse candidates. Because just because 2022 is going to be the matrix, 2023 is going to be, you need to start doing it. And by 2026, who knows, it could be other exchanges and the SEC may come out with different rules. So long story short, please have your nominating committee start having meetings early in 2022, if they haven't already, to start talking about this issue and start getting in front of it with consultants and see if they can start recruiting diverse candidates, because it'll be a real challenge if they wait till July to start thinking about it when they've got to put a matrix on their website or in their proxy materials.
Cam, I'm going to kick it over to you for about a 1 minute high points. So you can both quickly talk about exec comp on just a couple of points, because I think it is important, and then we'll have finished up.
Yeah, thanks, Kimberly. Well, hey, during the pandemic, I know a lot of companies have had to do some rapid adjustments to their executive compensation programs. These include special awards. It involves setting targets and metrics in very uncertain times, and then finding out that, maybe the payout and the original targets and metrics weren't quite the right fit, because performance wasn't exactly what it was expected to be. So there are adjustments that are going to have to be made to these executive compensation programs, and we've just included on the next slide, a few watch outs in terms of disclosure and governance. Next slide, please. With regard to how you talk about special awards, how you talk about performance period adjustments, incentive adjustments, reduced targets or increased targets. So just really just very generally, just to be cognizant that investors and the SEC are watching this area closely, and really spend a little bit of effort in making sure that these special awards, these pandemic adjustments are carefully disclosed and explained in your proxy statement. Do we have time, or?
I think we probably need to finish up and wish everyone a very happy holidays. The slides are there, so there's quite a bit of information in them. We put ISS came out with their voting policies yesterday, so there's some summary of that in the appendices. And so, from all of us at Dorsey, to you, very, very happy holidays. It was absolutely our pleasure to be with you today, and we hope you found it useful.
Okay, happy holidays, everyone.
Holidays.
Yeah,
thank you.